Hey there, welcome to the show. Les Solgrove with Simply Des Moines. This is week 10, and man, what a great weekend it's been. The Iowa Hawkeye women win the Big Ten Conference Championship, and the Drake Bulldogs men win the Missouri Valley Conference Championship, all in one day. Man, what a great day for sports. But you know what? Real estate has to continue regardless of what's happening in the sports world. So let's get started and see what's happening in Des Moines real estate. Hey there, welcome to the show. It is, like I said, week 10 for Des Moines and Central Iowa real estate. Les Solgrove here with Simply Des Moines. This is DesMoinesMarketValues.com. Weekly market update, the show where we talk about what's happening in the Des Moines and Central Iowa real estate market and try to make some predictions on occasion. But more often than not, we do a reflection of what's happened and try to figure out kind of the direction we're going to be heading here for the year. So let's get started with this week's show. And it's kind of a somber week. First of all, I want to take a moment and let everybody know that hasn't already probably heard in the real estate industry that we lost a giant this week. Steve Harney, who is the founder of Keeping Current Matters. And if you've followed my show at all, you know I've quoted his stuff over the years and used much of his material. I met Steve back 24 years ago and became friends with him. And also, he was a speaker at one of my several of my cyber professional group meetings that we held across the nation in the last 24 years. And Steve was just an awesome individual. He was the epitome of honesty and integrity. And I love that second quote down here. The value of honesty and integrity, particularly in the context of real estate and the financial advice, centers on the importance of having a teacher's heart in this business, advocating for transparency and trustworthiness over simply making a sale. That says it all about Steve and his attitude towards the real estate industry. He was actually absolutely a giant in this business, and he will be sorely missed. I know that his son has Bill and his staff are continuing to take over and continuing to make Keeping Current Matters a valuable resource for all real estate agents across the nation as well as mortgage lenders. So we're sorry to lose Steve this week, but man, what an industry legend, and we'll all miss him at all. So a lot here. So with that same theme in mind, we're going to take one of his slides from the recent blog post, probably back in January, I think is what this one came from. And it kind of ties into what we're going to talk about this week with mortgage interest rates. Back in January, they were making projections, and you can see where rates were in December of 2023 and as of January 2024. First quarter, they were predicting that rates would drop from 7% down to 6.4%. Well, they actually didn't make it down so far in the first quarter to 6.4%, but we're on our way down. We're currently about 6.9%, and that's kind of up a little bit here in the last couple of weeks. But I do think we're going to see mortgage interest rates drop here. He's predicting and Fannie Mae is predicting second quarter closer to that 6%, third quarter down right at 6, and then just under 6% for fourth quarter. And I think those are pretty conservative projections for the mortgage industry. And I'm going to have some reasons maybe why, or some explanations of maybe why that's the case as we move forward. So let's jump into some slides here for this week's show. This is a familiar slide from last year. I've formatted it for 2024 here, and you can kind of see that the 30-year fixed rate mortgage year over year, the red line is this year's mortgage interest rate so far this first quarter, and you can see right away that we are still the cost of borrowing mortgage money for this first quarter of 2024 is still above what it cost us even last year, just as rates were rising, and the 2022 was the year that rates rose. You can see in this purple line here where rates really rose, but we're still above where we were at the same time last year. And I'm hoping that we're going to get below 2023 rate values as we move into the second, third, and fourth quarter of the year. Um, let's see here. Let's go to the next slide. Uh, there's an old adage that I talk about frequently, and that is that home inventory tends to chase mortgage rates. And that's what you're seeing right here. You can kind of see as rates go up, it may not be instantaneous here, but as you see rates going up, you'll see that the uh, number of homes on the market tend to rise. So this gradual increase in 2023, you can see that our inventory rose as mortgage interest rates rose, and that's basically a byproduct of where home buyers were sitting back and saying, you know what, I'm either going to sit on the fence or I'm going to maybe not make that purchase yet. And so there's a lot of delayed purchases last year. And as we got toward the end of December or the end of 2023, if you recall, we had mortgage rates really drop quickly that last month or so from Thanksgiving on. And you can kind of see that it was a little bit of a lag, but you can see that our inventory actually started to drop as we got toward the end of last year. Now, as we started 2024, right in here, this little bit of number right here, you can see where that interest rates started to rise again, and we're starting to see that inventory start to come back up again. And so, even though rates have started to come down just a little bit, and we're starting to see a little bit of a rise of mortgage interest rates, I think we're going to see inventory possibly flatten out now as we move into that end of first quarter and into the second quarter, just because if rates are coming down and spring market activity, it's going to start to eat up our spring market. So you can see where we were kind of that first quarter of last year. So, and that's the number right there. You want to kind of watch this a little bit because we're going to talk about the effect of that here in just a second. There's looking at the year over year buying affordability. If you were to look at a $2,000 a month principal and interest payment only, not including the taxes and insurance, $2,000 a month would currently fund at the current rate of 6.9% would currently fund 304,292 mortgage amount. And so that's your buying power that I talk about. So $2,000 a month is going to let you buy something where you're going to be financing just over $300,000 so far. And that is still below last year. We could have a little bit more of a buying power last year, the early part of the quarter. And if you kind of look at this over here, um, you know, the buying power really didn't start to pick back up until we got around that Thanksgiving period to the end of the year. So hopefully we're going to have this green column chart here overpower last year's, and we'll start to see a little bit more buying power as we move into the year here. This is that same graphic again, just kind of looking at it from a longer, farther out perspective from 2018. And when you start to stretch that out, you don't see the major rises and lows and falls of that graphic, but you can kind of see here where we're kind of sitting right around that $300,000 price point here already this year, where we were above that starting last year. And so just it's a far cry from where we were back in 2021, where that same $2,000 a month principal and interest payment would have funded about a 500,000, almost a $500,000 mortgage at the highest point there. So we've come quite a ways when mortgage interest rates started to rise in 2022, and that's really affecting what you're seeing right here. The Another way of looking at the mortgage rates, and I like to show this from time to time. This is the 30-year fixed rate mortgage history by decade, going back to 1971 to present. So 1971 was the first year that the uh, Fannie Mae started to uh, follow mortgage interest rates on a weekly basis. And you can see here that for the first decade of the 1970s, the median rate was about 8.9%. Of course, the 80s were the bomb of the years. That decade, we saw mortgage interest rates on average about 12.8%. And then, of course, over the years, you can see as we get up here into the 2010s period and early 2020s, where those rates really, really dropped. And this is that huge spike. So, you know, the spike we're feeling today is very similar to what maybe home buyers felt, at least the feeling in the 1980s. Yes, home values were much lower back then, but guys, I think people would just lose their heads if they were paying a 12.8% mortgage rate today. I think that would just be terrible on their feelings about buying a home. You can see that the median rate right now in the 2020s, this decade so far, decade to date, so just the past 4.5 years or 4 years, I should say, We're currently at 3.69%. Now that seems low compared to 6.9 where we are today. But remember, we spent much of the first 2, 3 years sub 4% mortgage interest rates there. So again, median is half of the rates were above and half of them were below. We're going to see this number continue to rise as we move into 2024, 2025, most likely here. So, what is it that's really causing home buyers to maybe sit on the fence a little bit? And this comes from a presentation just this past week by the National Association of Realtors, and another mentor of mine, Dr. Lawrence Yun, was presenting. The competition for payment, for money each month. It's not just the mortgage amount. Yeah, rates could come down to a little bit or even a lot, but you still have to compete with other uh, factors of a home buyer's budget here. So you can see that from quarter 3 of 2022, credit card debt has risen from where it had been around that 15%. It's already up above 21, almost 22% right now of credit card debt. Personal loans have gone up as well as new car loans, and that doesn't even factor in the price of food and other daily, weekly and monthly staples that we see out there. So it's not just the rate, the mortgage interest rate that's coming, has to come down. It's other costs also have to come down before home buyers really kind of feel somewhat comfortable. And so the last slide here this week is, really what's going to create that environment where the Federal Reserve will begin to drop the federal funds rate. And they're basically looking at this consumer price index. It's currently at 3.1% in January. It's probably a little bit different than that here now as we get into March, but this is the number that Dr. Yoon was presenting. And he basically said, even though it doesn't seem like a lot at 3.1%, when they really, really, really want to get that rate down, that consumer price index rate down to about 2% before the Federal Reserve is going to start to make any kind of changes to the federal funds rate. So if we don't get down to that 2%, they're predicting somewhere between 3 to 6 times in the next 12 to 24 months that they will begin to reduce rates. It may only be a couple of times in 2024 is what we're hearing if this CPI does not get down there. So, but times are coming. I think 2024 is a recovery year, base year. We get near the end of the year, it's going to be a point in time where we start to see the real estate economy pick right back up again, and we get back in that build-up section there. So, anyway, that's the show this week. I will hopefully have a special guest next week. As some of you may know, I had suffered a little bit of an injury. I injured my hamstring on Saturday, and I'm not sure I'm going to be cleared for travel. We'll find out this week, but if I'm cleared for travel, it'll be a fun show next week. We'll have it from a different location. I'll have a special guest, and I hope you'll join me to see what that show is all about. If I don't make it with that special guest, I might Zoom that person in next week so we can have a fun time with that too as well. In the meantime, thanks again for joining me. This is Les Solgrove, Simply Des Moines. DesMoinesMarketValues.com is where all the graphics for each week's show reside, and also links to this week's video as well as previous videos if you're not picking this up on the social media channels. So we'll see you all again next week. Take care and be safe out there, and really be safe out there. Don't trip on stuff.